Welcome to the show. Today, we're gonna talk about mortgage. As we know, there's many headlines and many fears that towards interest rates and mortgage. So, if you are in the market of buying or even selling, our guest today, he will provide many different programs and talk about how can you approach towards buying or even selling for buying your second homes. Welcome to the show, Martin. How are you doing?
I'm great. Thank you for having me, Shelby.
Yeah, so as I mentioned, there's a lot of headlines, a lot of talks going on because the interest rate and people are still feeling fears
Yeah,
towards those interest rate hikes.
right?
And many buyer was in the market and now they're kind of pulled back.
Right?
So, and I've been seeing a lot of different situation towards either a first-time home buyer or
Mhm.
even a homeowner who's looking might be looking to sell, but they're not comfortable selling because they don't want to be selling lower price
Mhm.
than they wanted to. So today, I want you to share with our audience and listener about mortgage. So you
Sure.
want to kind of tell us your background a little bit and
Sure.
introduce yourself?
So, Martin Scott from US Bank. I've been
Hmm.
doing residential mortgage for 21 years
Okay,
and
good.
working mainly here in the Long Beach area, California, but I can do mortgages all across the nation.
Okay, good. So, so what do you see these days? Like, do you have a lot of people inquiring about loans, or do you see the numbers coming down just because of the interest rates?
So, it has been slower.
Mm-hmm.
We've seen a decline over the last, 6, 8 months.
Mm-hmm.
Rates are currently in a slightly upward trend, but as
Right.
this video gets released, that's gonna change as people see this at all different times.
Right.
So, yeah, I do have people that are fearful about doing pre-qualifications, first-time
Right.
home buyers and new buyers,
Yes.
and get those questions commonly. But it's always a good time to buy.
So if because I deal with a lot of first time home buyer as well.
Hmm.
So if a first time home buyer wants to buy a home, they usually think, oh, I need 20% down. So what kind of requirement that's usually a lender will need from those potential home buyers?
Well, there are multiple programs, so you can
Mm-hmm.
be as little as 0%,
Mm-hmm.
you know, to 20% is what people really want to get to, but you don't need that by any
Right.
means. FHA is going to be 3.5% down.
Mm-hmm.
Conventional starts at 5% down.
Mm-hmm.
So there's pros and cons, and it just really depends on the person's situation. And
Okay.
so I'm happy to speak with anyone who wants to talk to me about navigating through that process.
Okay, so let's say, for example, a homeowner, first-time home buyer, sorry, home buyer wants
Mhm.
to buy a home, and let's say their credit is in the 600s. Will that work
Well,
for
I am going to
mortgage
need
loan?
credit, yeah. And I don't want to get too specific because there's
Mm-hmm.
different things that
Right.
we can look at. But generally, a credit score 620,
Mm-hmm.
640 is better,
Mm-hmm.
but it's going to affect potentially rates and mortgage insurance. So,
Mm-hmm.
um, yeah, having that difference in that credit score being a little bit higher can make a dramatic effect.
So, as a realtor myself, there's a lot of home buyer that want to start, looking at homes and
Hmm.
shopping for homes. But I always tell them they have to get pre-qualified or pre-approval. So, what's the difference between pre-approval and pre-qualify?
Very good question. So, the difference between pre qualification,
Mm-hmm.
that's when I take the borrower's information and I look at it and I make sure that it falls within the guidelines. Pre approval, much stronger in getting an offer accepted, as we actually take a full application and it goes through a full set of underwriting. So, when you submit that offer, that seller's agent is able to look at that and see that it has a lot more credibility because it has already been through an underwriter. And then I follow up on that once an offer is made and I speak with that agent
Mm-hmm.
and let them know the strengths of that file
Mm-hmm.
and why this file is not going to fall out, and get lending and
Right.
take it over the line, and complete the process.
Okay. So at the time of this recording is 2023 in February. So there's a lot of cancellation like towards end of 2022. And it seems like okay, let's say I'm a buyer and I go to a lender and then I get approved or and even in escrow already. And then the Fed raised the interest rate, and then this buyer cannot get loans anymore because of that reason. Does that is that common in your
No, I really keep a good
applications?
pulse on that, and
Mm-hmm.
when we look at qualifications, we talk about that up front and talk about how rates can go up because the rate's not locked in the qualification process.
Mm.
So, you know, we work with them and we make sure that that doesn't happen. That's a super bad case scenario, and we don't want that to happen. That's not
Yes,
good for
yes,
anybody in the
yes,
process.
that's right. Yeah. So so if a first time home buyer let's say Texas, because we are also in the tax season while we're recording this.
Mhm.
Do they need to? I heard, I know we have to keep 2 years in a good tax. How do you say situation?
Yeah.
Yeah. So, do you have any like particular requirements on the mortgage side
So
on
someone
that?
who is, let's say, a W-2 employee, pretty
Mm-hmm.
simple, just 2 years of W-2s, 30 days most recent pay stubs.
Right.
If they have overtime, bonus, it's
Commission.
or commissions,
Mm-hmm.
thank you. It's best to have their year-end pay stub so we
Mm-hmm.
can see exactly how that's broken out and show that 2-year history. That's very
Mm-hmm.
helpful to have. Whereas a W-2, it doesn't break it out. So it's
Okay.
very helpful to have that. On the self-employment side,
Yeah.
we're gonna need most commonly 2 years of tax returns, personal and business, if they file business tax returns.
Mm-hmm.
If they've had their business for over 5 years,
Mm-hmm.
we may only need 1 year, most recent year of tax returns. So it just kinda depends.
Okay, so like myself, I'm a
Mhm.
self-employed entrepreneur. We always talk about tax deduction.
Right.
So, for example, if I'm let's say doing this show, and there's a cost for it, and I put it as a deduction, so the more I deduct, the less I make per se, right?
That's
So does
correct.
that does so that's a disadvantage for a person like in this situation,
Right. You
correct?
kinda gotta plan for it because that's
Mm-hmm.
what the underwriter is gonna look at. You wanna take all the deductions that you're allowed to take. Who
Right.
wouldn't wanna take all of those deductions? But trying to qualify for a loan,
Mm-hmm.
the underwriter is gonna look at that number. So they can add some things back in like depreciation and, we have a whole
Mhm,
crazy spreadsheet that we plug all the numbers into,
mhm.
um, to come up with the income to help understand what that would look like beforehand.
Right.
But you're absolutely correct. You kinda gotta plan for it because if you're not showing very much income, then
Mhm.
you're not gonna be able to qualify for maybe the loan that you want. I mean, loan amount.
So in the term of, showing a strong, year is like what, 2 years
2 years.
range?
Mhm.
2 years the max
Yeah,
that a self-employee will need?
correct.
Okay. Um, so also a lot of, that I encounter these days down payment assistance program.
Right?
Do you have anything that you wanna share with our audience or potential home buyers?
So there are some great down payment assistance programs
Mhm,
out there.
mhm.
I have done some of those loans in the past. They can be, I don't want to say challenging because they are great programs. And if you can utilize them, you really should.
Mhm.
Sometimes getting an offer accepted,
Right.
especially in a seller's market, that can
Yes.
be challenging because we have to disclose that and they'll see that on there. And so
Mm.
unfortunately, your offer might not be accepted over someone else's. But yes,
Mm.
they are great programs. We're going to have a good one coming up here in Long Beach.
Mhm.
LA has a great one. So,
Mhm.
yes, there are very good programs out there if you qualify into their select box areas that
Mhm. Mhm.
allow you to qualify for their program.
Yeah, so if any, potential buyer are interested to find out the, down payment assistance program, you can reach out to me or to Martin, and we will have some, information in the description below, right?
Right. And
Your
those funds, they ebb and flow as they become available and they get used up. So,
Mhm.
it all depends on the renewal of the funds as well from those specific programs.
Right. So just like I said, at this time of recording is February 2023. And so anything that we're sharing right now, it might change when you're viewing this.
Right.
So just want to put that disclaimer out there. So always contact your lender or us to see what's currently out there. Um,
Right.
so since we're talking about programs, what's the current mortgage program? Because since everything craziness is going on, market is very unstable, uncertainty right now.
Right.
So what program does your company
So
provides?
probably on the purchasing side, you've
Uh-huh.
probably be I'm just going to bring up the 2-1 buy down because that's
Okay.
what a lot of people are talking about.
Mm-hmm.
Um, I don't know if you've ever done one of those before.
No, not yet.
Okay. So where you most commonly see those and where they can be a real benefit actually for everybody
Mm-hmm.
is if the property maybe sits for, 30 days and you're thinking about doing a price reduction to the list price.
Okay.
So what you can do is you can offer this 2-1 buy down, which stimulates your buyer pool because what it does is for the first year, their rate is going to be reduced by 2%, and then the following year, reduced by 1%, and then the following year, it'll go back to that fully indexed rate. They also have other ones that are a 3-2-1, but most commonly the 2-1, and that's the best value.
And this is not it's not the same as the arms, right? The
No, so okay, yeah,
adjustable.
that's a great
Yeah.
question. So this would be say for a 30-year fixed,
Mm-hmm.
and let me just give an example. Let's
Okay.
just say that you have a purchase price of 1 million,
Yeah.
okay, and we're doing a 20% down loan amount of 800,000, and let's just say that original rate is 6% for that 30-year fixed.
Right.
So the way the 2-1 buy down works is for that first year, they would have a rate of 4%.
Okay.
And so they'd have that for the entire year. And then the following year, it would go up to 5%. And
Mm-hmm.
after that year, then it would go back to the fully indexed rate of the 6%.
Okay.
But let me just kind of share some numbers here. And I
Sure.
apologize.
No
Don't get
worries.
lost in these numbers.
Okay.
Um, for that first year, that payment,
Mhm.
they would save $977 a month.
Okay.
So for those 12 months, they'd save $11,724.
Okay. Right.
And then the following year, when it goes to 5%, they would
Mhm.
be saving $501.
Okay.
So over those 2 years, they'd
Right.
be saving $17,746. So the buyers love this program, but who's going to pay for it? The seller's going to
So
pay for it.
mhm.
So the reason the sellers might like it is this is a way that they might not necessarily have to reduce the pricing of their
Right.
home.
Mhm.
And I've commonly heard that 3.5% is
Mhm.
a common number. So in this case, that would be 35,000.
Mm.
But if you add those two numbers up for the savings, it would come out to the 17,700. So if they can get the house sold for that amount, uh, the sellers like it, the agents like it because commissions aren't cut, and
Mhm.
the buyers love it because they're getting that the cut in the payment for those
Right.
2 years.
Yeah, and also I want to mention the neighborhood will like it because if any
Right,
home that's sold in the same neighborhood, if the price drop, everybody's home drop.
right.
Yeah, that's how it goes. Um,
So that's why that program is
yeah,
super, super popular right now,
right.
and a lot of people are really utilizing it.
Okay.
Another program that U.S.
Mhm.
Bank has is that I've been seeing a lot is if you have a home equity line of credit, and let's
Mhm.
say that balance is 100,000, and with
Mhm.
rates they've kept increasing with
Mm.
the Fed because
Mhm.
that one does get affected by the Fed, not the daily rates.
Right.
So those folks have seen increases of up to 4%
Mhm.
over the past year, and so
Right.
they want something fixed and secure. And
Mhm.
so we can refinance those people into what we call a home equity installment loan,
Mhm.
and it's basically a fixed rate second. So it's on a 30-year schedule,
Mhm.
and it's a principal and interest payment, and it is fixed.
Mhm.
So, there's no prepayment penalty of any kind to get out of that. It's
Mhm.
just a really secure loan. So once people find out that we have that, they
Mhm.
jump on it and love it, and they thank me after they get it. And then
Yeah.
let's say rates because now I'm starting to get questions like, well, what if rates go down? I
Yeah.
got this fixed rate. I want to
Right.
take advantage of the home equity line of credit once
Uh-huh.
we start going on that downside.
Mhm.
Well, they can refinance out of it back
Again.
into another home equity line of credit.
Mhm.
And the reason they don't want to refinance the whole loan is
Right.
their primary mortgages right now are generally in the twos, threes, or fours. And if they were to do one of these refinances, they'd be in the fives or sixes most likely.
Yes.
So that's the reluctancy into refinancing it all into one loan because they don't
Mhm.
want to give up that fantastic rate that they have on their primary mortgage.
Mhm.
So this is a way for them to see that um, and get some relief and not have to worry about the rate potentially going up over time.
Okay. My last transaction, I encountered this homeowner who has reverse mortgage loan.
Okay.
What's your thought on that one? Kind of
I can't
compared
do
to what you just mentioned, because I'm just trying to do like a comparison for
right.
different type of
So
program.
reverse mortgage, I mean, there's
Mm-hmm.
definitely a target for them and they do make sense.
Mm-hmm.
You just got to really, and I can't do them here at US Bank, but
Okay.
you've just got to really make sure that the person understands that loan
Right.
and and they're comfortable with that loan. But
Yeah.
yeah,
So
it makes
that's kind
sense.
of eat up your equities,
It
right?
does eat
Kind
up
of.
your equity.
So yeah. All
So you're
right.
not paying a mortgage every month.
Yeah.
You're
You're
actually
gonna.
getting money back.
Yeah. So
So you're
that's why.
stripping out that equity. And if that's
Right.
something you want to do,
Mm-hmm.
sometimes the children don't like that. So,
Yeah,
but yeah,
whoever
that's kind
whoever's
of
in
that's a
the
decision you just have to make on your
trustee
own.
won't like
Right.
that.
So,
Beneficiary don't like that. Yeah. Okay. So, any thoughts of today's market? Like final thoughts, because we're gonna probably seeing a lot of different market shifting in 2023 and maybe go into 2024. You want to share that? Because we got about, I don't know, 5 more minutes if you
well,
want.
I mean, we're hearing that I hate to talk about rates and trends, but
Yeah.
the trends that I'm hearing right now is
Hmm.
they're going to probably be going down over the next 6 months. But once again, who knows?
Yeah. Who knows? Nobody
So,
knows what Phil
right,
would do. Yeah.
right, right. Yeah, just if you have any questions, reach out. I'll put my information
Yeah.
in the description, and I'm here to help out any way that I can.
Okay. Thank you for joining us on the Real Talk podcast show.
Well, thank you for having me.
Yeah.
It's always good to see you.
Yeah. Same here. Thank you,
You're
Martin.
welcome. Bye.